90% of retail traders lose money. That's not a scare tactic. That's the number ASIC published in their own research. 9 out of 10 people who try to trade their way to financial freedom end up worse off than when they started. And yet, right now, there are algorithms, automated trading systems running on basic laptops, quietly generating consistent returns for ordinary Australians who never watch a chart, never panic sell, and never make an emotional decision. Same markets. Completely different outcomes. The difference isn't luck. It's not even intelligence. It's the removal of the most destructive variable in trading. You. Now, before anyone switches off, thinking this is only for programmers or hedge fund quants in glass towers somewhere in Sydney, stick around, because algo trading in 2026 is more accessible than it has ever been, and most Australians have no idea how close they already are to being able to use it. Here's what most people get wrong from the jump. They treat trading like gambling with a strategy. They find a setup they like, maybe a moving average crossover they saw on YouTube, maybe someone's Discord call. They get in, they get nervous, they move their stop loss, they hold too long, they revenge trade after a loss, and 6 months later, they've torched 20 grand and they blame the market. The market didn't do that. Psychology did that. The market was just the arena. The brutal truth is that humans are catastrophically bad at executing rules consistently. You know what you're supposed to do, you just don't do it when real money is on the line and the candle is moving against you at 11 p.m. An algorithm doesn't have that problem. It doesn't care. It executes the rules the same way at 3 a.m. on a Thursday as it does on a Monday morning, every single time. That's the actual edge, not some magic formula, not a secret indicator. Consistency of execution, and it's something a machine does infinitely better than a human. So what actually is algo trading? Strip away the mystique. An algorithm in this context is just a set of rules written in code that automatically places trades when certain conditions are met. Price crosses a level, buy. Volatility spikes, sit out. Profit target hit, close. It's a decision tree that runs without you. The platform executes it. You set the parameters, you go live your life. The two platforms most Australian retail traders encounter first are MetaTrader 4 and TradingView. MT4, that's MetaTrader 4, has been around since 2005. It's clunky, it looks like it was designed during the Howard government, but it is enormously powerful and the lingua franca of Forex and CFD algo trading globally. Quick note, this episode contains affiliate links. If you sign up to any product mentioned via our show notes link, Hidden Yield may earn a commission at no extra cost to you. We only mention products we genuinely use or believe in. If you want to try TradingView yourself, we've got a link in the show notes. It's an affiliate link, so Hidden Yield earns a small commission if you sign up, at no extra cost to you. The free tier is worth starting with. Scripts on MT4 are called Expert Advisors, EAs, and they're written in a language called MQL4. TradingView, on the other hand, is where most Australians are spending time now. It's cleaner, it's browser-based, you don't need to install anything, and it uses a language called PineScript that is genuinely one of the more beginner-friendly coding languages in existence. If you can write a basic formula in Excel, you are closer to writing PineScript than you think. Here's the thing nobody says clearly enough. You don't actually need to write code to start. TradingView has a strategy tester built right in. You can take any published script from the community, thousands of them, free, apply it to a chart, and immediately see how it would have performed over years of historical data. That process is called backtesting, and it is the first thing any serious algo trader does before risking a single dollar. Backtesting is where most beginners either get it right or get completely fooled. And this is critical to understand. A backtest shows you how a strategy would have performed on past data. Past, not future. The mistake, and it's an incredibly common one, is curve fitting. That's when you tweak the settings of your strategy so many times that it looks perfect on historical data but falls apart completely in live markets. It's like writing an exam after you've seen all the answers. The strategy becomes a map of the past, not a prediction of the future. Good backtesting means testing on data you haven't optimized for. It means using something called out-of-sample testing. You train your strategy on, say, 5 years of data, and then you test it blind on the next 2 years you haven't touched. If it holds up there, you're onto something real. If it collapses, you've just avoided a very expensive lesson. So here are the 4 specific things to actually do if you want to start this properly without blowing up your account. First, pick one market and learn it cold, not 5 markets. 1. Most Australian retail traders starting out should look at either the ASX 200 index, which you can trade via CFDs through brokers like Pepperstone or CMC Markets, or major Forex pairs like AUD USD or EUR USD. These markets are liquid, they're well documented, there's decades of historical data available, and they behave consistently enough to be useful for strategy development, jumping between crypto, Forex, Commodities and equities simultaneously is how beginners drown. One market. Go deep. Second, get on TradingView. The free plan is fine to start, and spend 2 weeks just reading strategies without trading. Use the strategy tester. Look at the equity curve. Understand what drawdown means. Drawdown is the peak to trough decline in your account value before a new high is made. A strategy with a 30% drawdown means at some point your account dropped 30% before recovering. Can you actually stomach that emotionally? Most people say yes until they're staring at it in real time. Know your number before you go live. Third, paper trade before you touch real money. Most brokers offering algo-compatible platforms, Pepperstone, IC Markets, CMC, Fusion Markets, will give you a demo account. Run your strategy there for a minimum of 3 months. 3 months of live market conditions, real spreads, real volatility events, without a single actual dollar at risk. If your strategy makes money consistently on paper, you then graduate to micro-sizing with real capital. Start with a position size so small it genuinely does not matter if you lose it. $500, $1,000. You're paying for data and education at this point. That's the mindset. Fourth, understand the broker matters enormously. This is Australia specific and critically important. ASIC regulates CFD brokers here, and since 2021, they've imposed leverage limits on retail clients. Maximum 30-1 on major Forex pairs, 20-1 on indices. That's actually a good thing for beginners, even if it doesn't feel like it. It means you can't accidentally lever yourself into a margin call that wipes you out overnight. Brokers like Pepperstone are ASIC regulated, have competitive spreads, and support MT4 and MT5. That's the newer version, for algorithmic execution. IC Markets is another one used widely by Australian algo traders for its raw spread accounts and fast execution speeds, which matter when you're running strategies that open and close positions quickly. Now here's the Australian angle that almost nobody talks about. Tax treatment of trading income in Australia is not straightforward, and getting it wrong is expensive. If the ATO determines you're a professional trader, meaning trading is your primary business activity, your gains are treated as ordinary income, not capital gains. That means no 50% CGT discount. For most retail algo traders running a strategy on the side while working full-time, you're more likely to be assessed as an investor, and different rules apply. But the line is blurry. The ATO looks at things like how frequently you trade, whether you have a business-like approach, whether you're set up as a business entity. This is the kind of thing worth a single conversation with a good accountant before you start generating serious profits, not after. Getting the structure right from the beginning, whether that's trading in your own name, a trust, or a company, can make a material difference to your after-tax returns. If you're holding an SMSF or an investment portfolio with land, shares, or multiple asset types, ShareSite makes tracking your real returns genuinely simple. It handles dividends, franking credits, and tax reporting automatically. One of the most useful tools for self-directed Australian investors. Link in the show notes. We're talking potentially tens of thousands of dollars over a few years. Don't skip this step. There's also the question of what happens when an algo goes wrong, and they do go wrong. A strategy that worked in a trending market can absolutely bleed in a range-bound one. A flash crash, there was one on the ASX in May 2010 that wiped nearly 1,000 points off in minutes before recovering, can trigger stops in ways that are impossible to backtest for. Risk management inside the algorithm itself is not optional. Every strategy needs a hard stop loss on every trade, a maximum daily loss limit that shuts the algo down if hit, and a position sizing rule that means no single trade can meaningfully damage the account. The industry standard most professionals use is risking no more than 1 to 2% of total account capital on any single trade. At 1%, you can lose 50 trades in a row before you've halved your account. That sounds extreme until you hit a losing streak and you're grateful the rule exists. One more thing worth saying directly. There are a lot of people selling algo trading courses, signal services, and pre-built expert advisors online. Some are legitimate, many are not. The tell is the performance claim. Any system promising 10% a month or a 90% win rate or guaranteed returns is either lying or so over-optimized it'll collapse in live markets within weeks. Real algo trading strategies have realistic win rates. Sometimes 55 to 60% is excellent. And realistic monthly returns. The edge is in consistency over time, not in hitting home runs. Anyone selling you home runs should be treated with the same energy you'd give a cold caller offering you a mining stock. The hidden yield here, and this is the real point, is that algo trading done right doesn't require you to be glued to a screen. It doesn't require you to become a full-time trader. It doesn't require a finance degree. What it requires is a period of genuine learning, disciplined backtesting, a broker that doesn't rip you off on spreads, and the self-awareness to start small, test everything, and not blow your account chasing a feeling. The market will always be there. Your capital is finite. Protect it first, grow it second. Start on TradingView. Learn PineScript basics. There are free courses on YouTube that will get you functional in a weekend. Backtest obsessively. Paper trade for 3 months. Then graduate to real money in small sizes. Use an ASIC regulated broker. Talk to an accountant before your profits become a problem, and ignore anyone promising you the moon. This is a skill. Like any skill, it rewards the people who approach it seriously and punishes the ones who come looking for a shortcut. Hidden yield is about finding the money hiding in plain sight. Algo trading is one of the few places left where a retail trader with the right approach can genuinely compete, not against professional firms with billion-dollar infrastructure, but against their own worst instincts. And that's a competition worth entering. If this was useful, share it with someone who's been burning money staring at charts at midnight. Subscribe wherever you get your podcasts. And if you've got questions or you're already running a strategy and want to talk through it, find Hidden Yield at hiddenyield.com.au. More soon. Quick reminder, everything you just heard is general information only, not personal financial advice. It doesn't take into account your personal circumstances, objectives, or financial situation. Always chat to a qualified, licensed professional before making any financial decisions. Now go get more. hiddenyield.com.au.